Here we are looking at the live market for the British pound Australian dollar. Its volatility and liquidity isn't as spectacular as other assets in the market, as I described in my last video, but it is a wonderful market to really begin moving from a demo account to a real live money account. And that's what this is, my live money account, where I have been lazy trading for quite a while now. Hello, I'm Robert and welcome back. Let's get into the charts. As we can see from previous videos, my most recent entry order has triggered. Now that puts us at 8 orders for this particular pair. I don't want to go above 10 for obvious reasons within the account. That's 10% of my account tied up, and this account is used to trade more than one pair. That's a consideration to make when you begin to first trade, and I recommend you keep each pair in its own account just to make it easier to deal with that. But the downside is that you're splitting your money between different accounts, which means you're going to affect your own liquidity in doing so. So there's trade-offs to think about that are realistic and equally just as complicated. By keeping all your money in one account, you give yourself more leverage per position, but you also increase your risks. And that is something that you must always watch. Right now, my risks are 14% of this account. That is a problem if the market really goes hard against me, and something that I will have to carefully watch. It's a problem in that I could have my account margin closed, meaning the values here accelerate out of control and my margin available hits 0. You don't want that in your real account. That is disastrous. That is the potential of losing your entire holding. And for me, that would be a large chunk of my account. So you must really work on your risk management processes. And if it comes down to it, take the hard losses. Save your account, save as much of your account as possible, and do not, under any circumstances, let a margin closeout happen. Risk management is everything, and there's simply no other way of wording it. For example, right now, I stand to lose this amount on each pair if a margin closeout happens. That is a lot of money. That is a huge hole in my wallet. So risk management is absolutely critical. In keeping your account properly protected, it means really thinking about how you want to trade. I have 8 positions already in my lazy trading pair. If I zoom out and you see where the market is in relation to where it has been, we can clearly see the market is in a rather aggressive uptrend at the moment. My own personal thinking process in looking at the order book and in looking at other components of this particular market is that eventually, looking at how we are at the average on the far left of the chart, that this is going to form a bell-shaped curve, and we are going to go back down to this average. That is, this is a cyclical market, and I just have to manage my risks appropriate to the cycle. So let's get the order book on this and see just how abysmal it is. Remember that from the standpoint of the charts, This particular pair does not have an overly bright order book. And it is turned on. Okay, that's disturbing. So we have the order book turned on, and there is so little volume and liquidity in this market, it's not even showing up. That is disturbing. But that is part of the process of learning, which really is the whole point of your beginning steps. We've done the demo, now we do the live account, and we have a market that is so low, the order book doesn't even show up. Let's see if I can get it to coerce it in. Be right back. Okay, I got the order book back on the chart. I had to disable it and re-enable it. So we can see, though, it's still disturbing that it's not very much. But we do have something of interest on the order book that is important. We have this section here that has higher than normal short-long combinations, or sell buy. The red side is the sell side or short side. The green side is the long side or buy side. And we can clearly see that the buyers and sellers have a point of which there is a slightly higher level to work with. This is good because this clearly shows us that we have a level within our order book that shows consensus of how high we're going to go. But if we look lower, we see in the lower ranges that both the buyers and the sellers want this price to go down much, much more. Back to the average or mean that we see. Remember, the purple line is the mean between the highest high and the lowest low, and the reddish line is the average price of the market, or what many would call the fair value of the market. By looking at what we have on a chart, we can clearly see that I have been in the market since around early March. Not a bad market, really, in terms of what this market is. It's not the greatest for the order book, but that's fine. Because the one thing this market is going to force me to do is be patient. I don't want to just get out at a loss. I am not willing to accept a $50 loss when I can just sit here and hold it. This market is pretty straightforward in its approach. We have a pretty clear boundary of how high the price is going to go. It might, and I emphasize might, shoot way up here towards the upper boundary of the range I am looking at, as defined by the resistance level of the yellow line. Now, does that mean that they ever care about what I think the resistance is? No. Nobody cares about what I think the market resistance is going to be. That is the point of all technical indicators, all fancy drawings on the chart. They only matter to you. If you think they hold value, that's all that matters. Because for the rest of the world, your thoughts don't matter in a market with thousands upon thousands of other participants. So always trade according to your own personal risks. Because if you try to follow somebody else's program, you're going to lose money. So now that we've got a clear view on the chart, we have the upper range in sight, we have the market median in sight, and we have the market average in sight. From here, we have a reasonable level of expectation that the market is simply going to make an arc and drop down into a inverted bow shape, or a bell curve, if you want to call it that. Overall, I think this is the direction we are going to go. If you wanted to really capitalize on a sneaky trick for the market, if you can really call it that, you could put a limit order up in this range so that if the market triggers and then bounces back hard, you get that money. Kind of like what it did on this particular section here. So by using this kind of an approach, if it shoots up and triggers your order and then it drops back down aggressively, you could walk away with a very sweet and really nice profit. In fact, let's do that. It doesn't cost us anything to put an entry order in the market until it actually triggers. So let's go ahead and set that up, just in case we get another surprise like we did previously. So let's go ahead and let's open up 160 units. And now let's drag it to where we think the markets might be. We can go to the highest candle, we can go to the second candle, or we can go to just below, in between the yellow line and the highest high of the candle in question. What I personally am going to do is going to go roughly to where the second candle is so I can capture it. Just a little bit. There. Now in doing so, if the market shoots up and spikes, my order is going to trigger, and then when it hard reverses, I'm going to rake in all of that profit. If the order never triggers, it doesn't matter. It sits there without affecting my account until it expires, which is perfect for what I want. So now I'm going to submit it, and that's it. So now if the market does what I think it will do, eventually these will all sell off. But if the market goes completely against me and really goes out of its way to just try to wreck my account, then I've got this order up here, the 160 units, ready to capture that momentum and try to capitalize on that hard reversal. This is the kind of tactics that you will learn in time through practice and through actually studying the market. There are a lot of different strategies, techniques, and principles you can read about all over the web, but none of them matter in relation to you just actually using common sense on the chart, looking at the chart, finding out what works for you, for your trading context, for your risk assessment. That is what decides your success rate. Not some magic indicator, not some magic theory. You finding out what market resonates with you. This market has thousands upon thousands of participants worldwide. It's a good market to be in because it's a comfortable market. There's not really a lot of crazy situations. Once in a while, you'll get something that just comes out of nowhere. But for the most part, this market is very consistent and very profitable. So, always keep in mind your own personal risk assessment. I know I harp on that a lot, but it's easy to get caught up in a moment with the market. It's easy to get caught up in the excitement of a market rally, of a huge, monstrous green spike that just drives the market completely upward. And people think it's going to keep going forever, when, unfortunately, it doesn't. It just bottoms out. That really is the big lesson here. In fact, let's zoom into this market and really look at it. There we go. This big monster candle. This is a nice candle. It's a whirlwind of profit if you got in down here. But if you came in after the fact and thought it was going to continue somewhere up in this area, you would have been rudely hurt by this sharp downward possibility that occurred 3 days later. There is no way to predict what the market is going to do. It's just that simple. If you try to actually predict what the market is going to do, you are basically trying to read the minds of tens of thousands of people, all of whom have different expectations, different agendas, different reasons why they wanted to get in that particular place. Whether they thought the market was going to go up, or whether they got in right at the magic moment and they waited for the market to go down. There's just no way of knowing what somebody is thinking. And that is the biggest problem about trying to predict market behavior. You are not a mind reader. And if you are, I strongly suggest you have a psychologist on hand, because that's going to drive you crazy. Realistically though, and that is a problem, trying to understand human emotion is in and of itself its own science. Throughout my own trading career, throughout my own programming career, throughout my work in artificial intelligence and natural language processing, understanding human emotion has been a 30-year journey for me. And even today, as much as I have studied, read, researched, and wrote my own programs for, it is still just as much an enigma and a illusion as it was 30 years ago. I have degrees in computer science and a PhD in theology, and none of it matters when you study human emotion. None of that knowledge has any bearing on the chaos that goes on within the human brain. It's important that you keep that in mind when you trade. Simply accept the way the market is going. Stay to proper risk management. Stay within your risk assessments. Never over leverage your account, and you will make money in it. You're not going to be guaranteed to get rich in it, and you're certainly not going to spend your days on the beaches sipping pina coladas. That just doesn't work unless you have a lot of money to begin with, in which case you're not going to be trading by yourself anyway if you've got that much money. I hope this video has helped you look into the real world of real trading. That is, taking the concept of a demo account and then applying it to a real live money account, where there's actual live money on the table that you could potentially lose. There is no easy way of making that step, except to just accept that you could potentially lose everything. It's a hard step to begin with, but if you stay at small values and you think carefully about your trading techniques, that is, you only buy when and only when you think you have an opportunity, you can do well. The biggest hurdle you will ever run into in trading is your own mind. If you can control your own emotions, you've beat 95% of all people on the market. If you like this video, please give it a thumbs up. Please help me grow this channel. Please leave me a comment and let me know what you think about this market or any market you are looking at. What makes it special to you? Every market has a place to somebody, whether it's a slow market or a fast market. It has unique opportunities. What makes your market special to you? Let me know. Thank you for watching.